This is Kathy from Blockchain Alpha, and today's video is about backtesting a trading strategy. Let's get right into it. Profit and loss probability for a trading strategy can help traders enhance their trading efficiency. Backtesting is a method for simulating trades using historical data to predict how a newly developed trading strategy will perform. It suggests a time-tested strategy rather than resorting to fast fixes. This video will guide you through the process of backtesting a trading strategy. How to backtest a trading strategy. Backtesting means simulating trades with historical data instead of real money, in order to determine the success of a trading strategy. The premise behind backtesting is that a profitable trading technique from the past will continue to yield profits in the present and the future. When traders see evidence that a strategy will succeed in practice, their confidence in that technique grows. If a trading technique fails to perform well, traders will need to decide whether to improve it or discard it. Before beginning backtesting, traders ensure they have a trading strategy, a projected risk and return, and historical data on financial assets. It can be done either manually by a human or automatically by a computer. Manual allows traders to examine prior data and make trading decisions based on that analysis. To speak of a backtest as automated means that it is conducted by the software without any intervention from the user. Backtesting trading strategy manually. 1. First and foremost, you should have a well-developed trading strategy and plan. The financial market, the period of trading, tolerance of risk, and objectives of profit are all considered when developing a trading strategy. After a trading plan has been created, the trader can begin to formulate an actual strategy. While most traders do keep some kind of rough strategy on hand, it wouldn't do much good to put an undefined strategy through any kind of testing. When developing it, it is important to establish clear goals and limits. By adjusting the strategy parameters, traders can gauge the efficacy of a trading system. 2. Specify a time frame and economic climate. First, the trader must decide on a trading strategy, and then, after that, a financial asset and market. An investor would need to zero in on the equity market in order to backtest a strategy for a chosen share or shares. The foreign exchange market is where the buying and selling of currencies occurs. It is also up to the trader to decide how far back in time he or she wants to go when gathering historical data for use in backtesting. The best time to make a trade depends on the trader's chosen approach. Data collected on a monthly basis, for example, will produce different results than data collected once a year. A trader's chosen time frame should be consistent with how the market actually functions. 3. Get going with a backtest to investigate results from the past. When a trader settles on a trading strategy, market, and time frame, he can start keeping tabs on market activity during that time period. Market movement and buy or sell signals can be analyzed if the trader follows the strategy's rules. With this information, he can evaluate the necessary investment in light of the potential gross and net returns. He will move forward with the strategy if the outcome confirms his hypotheses. If it doesn't work out right away, the trader will need to make adjustments. How to use software to backtest strategy. Different software packages offer different options for simulating historical market conditions when backtesting a trading strategy. But in most cases, these steps are taken. Choosing the right financial market and time period is the first step. Determine your initial investment, portfolio size, benchmark, profit target, and stop-loss instructions. Backtest your assumptions. It is possible to make adjustments to a strategy that hasn't worked so far. What is the most reliable method of backtesting? The idea that there is one best backtest strategy is highly subjective. Different traders find approaches that work best for them based on factors like their goals, tolerance for risk and profit, preferred markets, level of experience, and so on. It's possible for even inexperienced traders to benefit from one of the simplest backtest strategies, manual intraday backtesting. Technical charts allow traders to analyze past transactions based on their trading strategy. This will allow them to see how prices are moving over time and how much money they could make or lose. Forward testing is another strategy a trader can consider. During a forward test, no real money is at risk because all deals are made on paper. Every trade and its resulting profit or loss is recorded by the program. In addition, real-world data is considered in forward testing. Traders can get a clear and reliable picture of a strategy's likely performance because both historical and real-time data are considered. Free backtesting software. You can better predict future outcomes by looking at how well your strategy performed in the past with the help of backtesting software. Numerous tools, both free and paid, exist to backtest trading strategies. Free backtesting software includes Excel, NinjaTrader, TradeStation, TradeBrains, TradingView, and many others. Using Microsoft Excel and a few simple formulas, backtesting can be performed quickly and easily. There are probably more robust choices, but this one makes trying out a strategy as easy as possible and in as little time as possible. TradingView's trade facilitation software is useful for both stock and currency traders. Because of the market replay function, traders can manually backtest their strategies and view day charts in the correct time frame. NinjaTrader is yet another free backtesting software option for those interested in futures trading but who prefer to test their strategies without taking any actual financial risk. It supports 2D and 3D optimization graphs and provides examples of how to use it. TradeStation is the broker industry standard for historical trading analysis. Traders can use it to set up robotic processes to monitor their positions. Mistakes often made when doing backtests. The following are some common pitfalls that traders make. Using low-quality data. The adage, a garbage in, garbage out, is often repeated in the realm of data-driven trading. Accuracy relies on using high-quality datasets, so traders should be wary of providers who don't. Confronting weak sample sizes in historical testing. Due to its limited usefulness, it is not applicable when a strategy has only been successful for a short period of time. It's generally agreed that traders shouldn't backtest strategies with less than a year's worth of daily trading data, though the precise amount of data required varies depending on market conditions. The use of overfitting techniques. To overfit is to optimize a backtested strategy to produce positive results without giving much thought to whether or not the relationship between the variables is reasonable. This causes an inaccurate portrayal of the strategy's predicted effectiveness. Identical information. Many of the backtest trading signals will be redundant after a period of several days or weeks. It is essential to remember this before blindly trusting the results, as future returns will be similarly intertwined. So in conclusion, the ability to test out trading strategies using historical data is a godsend for modern-day traders. It can be done by anyone, from retail traders to institutional investors. Traders shouldn't put all their faith in it, despite its effectiveness, because it can't see into the future. It improves the reliability of forecasts when used in conjunction with other technical indicators. Before you go, please like, share, and subscribe. Click the box above to watch one of our other videos.